Hello, everyone, and welcome to Economics Unplugged with Raj. In this podcast, we engage in insightful conversations with leading economists and esteemed professors, exploring the complexities and dynamics of the Indian economy. Join us as we unravel the nuances behind the numbers and make sense of the ever-evolving economic landscape. So today I have honor of hosting Dr. Radhika Pandey, a senior fellow at the National Institute of Public Finance and Policy and a distinguished economist with an extensive background. Dr. Radhika Pandey played a pivotal role as the lead coordinator for the Ministry of Finance Task Force on Public Debt Management Agency, and she contributed to a several high-level working group on the broad spectrum of economic issues. She is also a prolific writer, widely recognized for her weekly column Macro Sutra, which offers in-depth analysis of contemporary macroeconomic issues and is featured in the print. So, in today's episode, we will be discussing the Union Budget 2025, presented by the Finance Minister on 1st February 2025. The Union Budget serves as the government financial blueprint for the coming year, focusing on the key areas such as revenue and expenditure planning, inflation and fiscal management, taxation policies, and many more. This year's budget was with a notable highlights including changes in the tax slabs, increased support for agriculture, enhanced allocation for research and development, among other impactful measures. So let's deeper into the implications of this year budget with Dr. Radhika Pandey and understand its potential impact on the economy. Thank you so much, Radhika, for joining this call and shedding your light on the budget 2025. So, the first question is a very obvious question. So, what do you think this budget is? Is it a populist budget or a government, genuinely aimed at sustainable economic growth?
So I don't see it as a populist budget because we have to first look at the context in which this budget is being presented. And if you look at the context, before the budget growth numbers came out, the advance estimates of GDP for the current year, and it showed that the growth had is expected to moderate for this year at 6.4%. Consumption is lower, investment is lower, and particularly in consumption, it is the urban consumption which is subdued. So there was a lot of demand that something needs to be done to bolster consumption, and towards that, the budget has taken some decisive steps in terms of announcing substantial income tax cuts in order to spur consumption. So that is the point, and it's not populist. It's like they have tried to balance boosting growth, but at the same time sticking to the path of fiscal prudence, because for the current year also the government has done budget better in terms of its fiscal deficit target. Initially, the target was to achieve a 4.9% of GDP as a fiscal deficit, but it has managed to achieve 4.8%. For the next year also, earlier target was 4.5% of GDP as a fiscal deficit, but it has kept it at 4.4%. So it has tried to navigate the path of boosting growth while sticking to fiscal prudence. Now we can always go into details as to how it has, the government has tried to achieve fiscal prudence, and it's mainly through expenditure cuts rather than through revenue augmentation. And there, it's the capex outlay where the government has done savings. It was not able to spend the budgeted amount, and therefore there was a saving of almost 1 lakh crore in capex outlay for the current year, and that has resulted in it achieving its fiscal deficit target. But overall, it's a good budget. It has some good points about Viksit Bharat vision and all, and it's not populist.
So coming to your point that as you mentioned, that it will boost the consumption. So don't you think it's always a short-term boosting consumption? I mean, there are other ways, you can boost consumption like businesses, capital expenditure, which is also happening, but it's most of the budget that is being presented in most of the years. One of the main that everyone wants to see is the tax tax cut. But the thing is that why not? And Now with that, it's gonna give 1 lakh crore to the middle class people, to everyone. So why not probably cutting a GST a little bit on essential goods, or removing GST on essential goods, which will, first of all, it will be a long-term sustainable economic growth and a boosting, and it will continue to boost instead of just giving a certain section of society. What do you think? Like, why that cannot be possible?
So that's not possible as part of the budget because GST announcements or GST cuts, GST rationalization decision are made by the GST Council, and there the state governments have to come on board to decide whether they are going to cut GST. Of course, you are right that GST cuts will have implications for a wider set of population because income tax, if we look at how many people pay income tax, it's less
Exactly.
than 7% of the population. And there also, how many people pay positive tax? There are people who file income tax, but how many people pay positive tax? The number is much lesser. So it's going to impact a lesser section in terms of the numbers. It's going to impact a lower proportion of the population. But then we have to see that there is something called consumption multiplier. That when you put money in the hands of people, depending upon the marginal propensity to consume, there is going to be some multiplier. Now we can always argue about whether the marginal propensity to consume is zero point 0.8 or zero point 0.7 or zero point 0.6, depending upon whichever MPC we assume. Like the previous chief economic advisor has done some calculations and he says that this will boost consumption by rupees 5 lakh crore.
Yes.
He assumed MPC of zero point 0.8. So it's going to have an impact, and you are right. There are various other factors because some people will try to boost their savings first. Because if you look at the trajectory of gross savings of households, they have also hit rock bottom due to COVID and other expenditures. Savings have been lower. So some of this will be used to build back on savings. Some of this may be invested in stock market. So there are various leakages from the system, but eventually there will be some short-term boost, and ideally it should be followed by some form of GST rationalization. But that is a very difficult proposition where state governments have to come on board and they have to look at their finances. And given the extent of freebies that are being doled out, it's very difficult to take a hit on revenues by further slashing GST. So what the central government could do as part of its budgetary announcement, it has done what it could do to spur consumption. It's going to be a short-term boost, but then the multiplier impact will have an impact. And capex outlay is also there, which is almost again at the same level. It's a non-trivial number. It's a big number, and if the implementation bottlenecks can be avoided, that multiplier will also work. So capex multiplier, consumption multiplier together is likely to give us boost to growth and consumption.
So one question related to the marginal propensity to consume. So as you mentioned, it is 0.6 to 0.8. So
Right.
is there any definite calculation that has been done in last recent calculation 5 to 6 years, that by spending or boosting of 1 lakh crore and keeping direct money to the middle class and everyone, is it going to increase the consumption by 5%? Exactly, or because I said there are leakages, because people are not even saving it, it is going to the stock market, which Indian banks are facing quite a lot, that it is not going. So is there any something that says, okay, it will increase by 5% and keeping the capital expenditure aside?
So there are different MPC values for different income tax brackets. Those who are in the lower section, lower income tax bracket, their MPC is higher
One,
as compared
okay.
to those who are maybe earning, above 15 lakh or 20 lakh per annum. Their MPC will be lower. So there is no definitive study as such, or there is no definitive conclusion, and we'll have to wait and watch for some of the variables where we could see a boost to consumption. We can look at the profits or sales of the FMCG companies, because that is a very good indicator of where consumption is going. And if we look at their commentary, which comes out every quarter, it says that till now what they are feeling is that rural demand is quite okay because of the good monsoon and because of the boost to agriculture, but urban demand is not picking up. So we will be able to see going forward after this decision has been implemented, what its impact will be in the next 2 3 quarters. But we don't have any, there is no certainty because the behavior of individuals keeps on changing, and there are lots of conditionalities, there are lots of leakages from the system. So that all has to be considered.
Yeah, and recently all the FMCG company has also mentioned that their urban profit has deaccelerated over a
Right.
period of
Yes.
time.
Yes.
And there are many other reasons because small organic companies, small startups are coming that they are taking probably those kind of profit. So with so much of boosting consumption, everything. So as we all know that inflation, which has been very high in India for last few years, especially after COVID. So do you think that this tax budget cut boost will actually give a relief to a middle class people because of this inflationary pressure? And also, second one very important thing that inflation numbers is fine. Okay, we say 6%, 5%, but actual we say the life is still pricey. I mean, the
Mhm.
numbers, because there are other components of the inflation that we don't consume on a daily basis, apart from food, energy, and the basic things. So its life is still pricey. Do you think this will little bit give a comfort, and maybe our MPC also increase the marginal propensity to savings also increases, which has also decreased after COVID
Right.
over a period of time.
Right.
So how about what do you think on that part?
No, that's true because inflation has been elevated, and particularly food inflation has been elevated in the recent years, and at the same time, core inflation has remained within limits. So it was within 3 to 4%. It's quite stable. So mainly because of the persistent food price pressure, the individual's discretionary spending was hit, and with this some amount of increase in disposable income in the hands of people, they would be able to do some discretionary spending. They would be able to increase their discretionary consumption. So definitely, even if we look at what happened to the shares and stocks of FMCG companies, they increased. They were quite optimistic and they were happy with this decision because they feel that this will give a boost to consumption. And at the same time, now there is some good news on inflation front also, that we are seeing that food prices are also getting reined in. So cumulatively, the impact of all this would be increase in disposable income and some boost to consumption.
Yeah, I mean, there will be a boost, but the other side of is true, the capital expenditure and the maintaining of the physical deficit. So, moving toward the physical deficit one. So, recently you wrote an article on the budget where you mentioned about debt to GDP kind of consolidation of debt, which what other the entire world do. So what do you think about that? And if you can explain what that exactly mean, debt to GDP ratio, physical way of maintaining the physical deficit.
So what has changed is that till now, what is our fiscal framework is that the government comes up with a target for fiscal deficit to GDP ratio, which is essentially the excess of total expenditure over non-debt receipts. We don't
Yeah.
include borrowings as a part of receipt. So the deficit is as a percentage of GDP is something which is targeted every year, and that is something which is embedded in our FRBM, which is the fiscal responsibility and budget management legislation, where so the targeting is based on fiscal deficit to GDP ratio. And in the FRPM, it's mentioned and it's not been amended. What it says is that by 2021, we had to achieve a fiscal deficit of 3% of GDP. Now, all that thing does not is not meaningful now, because after COVID, our fiscal deficit shot up to quite high numbers because of increased spending commitments and so on. But then the 15th Finance Commission gave a glide path that, follow this glide path, because, after COVID, now we need to come back to a trajectory of reducing fiscal deficit. So as per that, by 2025-26, the fiscal deficit should be reduced to 4.5% of GDP. which the government has tried to follow as its medium term target. And in this year's budget, it has said that for the next year, that is 2025-26, it will not only achieve 4.5, but will do better at achieving 4.4% of GDP. But beyond that, after 2025-26, it's going to change its anchor from fiscal deficit to GDP to debt to GDP ratio, which is a stock variable. It's the
Yeah.
outstanding stock of Government of India liabilities as a percent of GDP. And why this is important is that if we look at the various sovereign credit rating agencies, they look at this number with great interest. That what's your are you able to reduce your stock of debt as a share of GDP over the years? So that is important. In 1 year you may be able to increase your revenue and decrease expenditure, so fiscal deficit might come under control, but your stock of debt has to come down
Come down
materially.
for
So
overall long-term growth because
yes, so that is what now the government has done, that it has shifted from targeting fiscal deficit to GDP to targeting a debt to GDP ratio. So it says that every year the fiscal deficit to GDP ratio will be fixed in a way that debt to GDP ratio comes down every year. So there should be a reduction in debt to GDP ratio such that by 2031 the debt to GDP ratio should be around 50% of GDP. So this is for the central government. Now we can always argue that this is a very, it should make it 40% or
yeah.
45%. So that is there, but at least they have articulated a framework, and they have come up with something called a medium term glide path, saying that each year they will reduce its debt to GDP ratio. The central government will reduce their debt to GDP ratio, and by 2031 they will try to achieve 50% of GDP plus minus 1%, depending on the various exogenous shocks and so on. So this is what they have changed from fiscal deficit to debt to GDP ratio as the main anchor of fiscal policy.
Yeah, I mean,
And because they have given this, the documentation is there as part of the budget statement, so it imparts transparency to the fiscal framework, and it's for there to for everybody to see. It gives a signal that okay, the central government is serious about reducing its debt to GDP ratio.
yeah, and also it resonates with the other developing countries because they are also working on that debt to GDP ratio, though
Yes,
their
yes,
debt is more than 100% of their
correct.
GDP ratio.
Yes.
But one question that came to my mind with this, that it can go on a positive side and negative side both. For example, our rate of interest is so high. So, I mean, rate of interest is so high, and of course, every year, and this COVID came, and they all, disrupted the entire planning of reducing the interest rate, increasing the consumption. So now it's 6.25, if I'm not wrong, 6.25 the repo rate. So the one of the main issue with the debt to GDP ratio is that if our interest component will keep on increasing and adding to its overall debt because our interest rate is high. So will it keep the debt to GDP ratio is almost near to its 50% or 55%, or how do you think it's gonna go in near future?
So there's a lot of work on this. Actually, what we need to look for this is the debt sustainability. There is this entire topic called debt sustainability analysis, where what we look at is the growth rate and the rate of growth of interest, growth of GDP and rate of growth of interest. So long as the rate of growth of GDP is higher, that is what we are supposed to do. That now we have to ensure that the growth rate of GDP is higher so that the debt to GDP ratio comes down.
Comes down,
Uh,
correct?
so that is one thing that it has to do. And on the other side, you are right that the interest cost has to be lowered significantly, and towards that the government is doing steps, because if you look at the net market borrowings for this year, the target for net market borrowing, it's actually lower than last year. So last year it was 11.63 lakh crore as per the budget, and this year they have targeted as rupees 11.54 lakh crore. So in absolute terms, the net market borrowing has come down, which should bode well for bond yields, which should bode well for government bond yields. So every year, if they are able to reduce the net market borrowing, then the bond yields will come down. And at the same time, the focus has to be on boosting the growth rate of GDP so that we are not in a situation of a debt trap kind of thing where we are, borrowing to pay our interest payment. Because the other condition of debt, a sustainable debt, is to have a primary surplus. And India cannot have a primary surplus because our non-interest expenditure is higher than our receipts. So
Okay.
what we can do at best is to ensure that our G is greater than R, which is the growth rate of GDP is greater than rate of
Rate of
interest,
interest.
and that will lead to a sustained decline. And at the same time, we have to do our debt management in such a way that we focus more on long-term debt rather than short-term debt. We do some switching and rollover such that the cost of debt remains lower. So a lot of these things have to be kept in mind. But of course, given the volatile situation that we are living in, given the uncertain
Yes.
situation, there are lots of things that are going to impinge upon the government bond yield. So it is something that, because now the government has embarked upon this framework, it will do something so that every year the debt to GDP ratio comes down. So that's a very credible thing that they have done.
Yes, because as you mentioned that we should not get into that trap, which is what United States are in. So their one of the highest expenditure is
Correct.
more than 10% interest is going towards the debt payment. They are taking the debt and then paying the interest towards that.
Interest, right.
And by 2030, it's gonna be very, very high. So I mean
Right.
that is the issue with the debt to GDP ratio. Even though their interest rate was so low, they did the
Follow.
same.
Right. Yeah. Yeah.
So with that, physical consolidation, as you mentioned, that we are expected to achieve a physical deficit of 4.4% at the best, and
Right.
or at least 4.5% by next year, and this year it's 4.8. So one hand we are saying we are giving direct money to consumer 1 lakh crore, and second side that we have a plan of a high capital expenditure because that is also required to overall boost the economy and increase the GDP rate of growth. So, how the physical deficit of 4.4 is expected to maintain? Is it just this is the reason which I was thinking that the budget was a populist just to show the numbers 4.4, but is it achievable from the is it real to achieve or not?
Yes. There are two things here. Whether fiscal deficit is the target of 4.4% is achievable or not, we have to look from the tax side, that is from the revenue side, and from the expenditure side. Now, from the revenue side, there are two forms of revenue: tax revenue and non-tax revenue. Now, within tax revenue, if we look at the income tax projections and corporation tax projections, yes, they do appear a bit optimistic. They do appear on the higher side because despite income tax cuts, the budget is projecting a 14.4% rise in income tax collections over the revised estimates of the current year. That looks a tad optimistic. Similarly, corporate tax collections are budgeted at 10.4%. They are expected to grow at 10.4% over the current year's revised estimates, which again looks a bit optimistic because for the current year, the growth rate estimate has been slashed to 7.6%. So, unless and until there is a sharp rebound in corporate profitability, which is unexpected given the uncertain situation, it's hard to see how the corporate tax collection might grow at 10.4%. So those two are the projections which are optimistic, which may not play out in the for the next year. But where the government would be able to achieve is it has done a lot of expenditure rationalization. One is the revenue expenditure. Revenue expenditure is expected to grow by only 6.7%. And net of interest payments, if we remove interest payments, revenue expenditure is likely to post a growth of only 4.3%. And I have an article today in the print which shows where we have a graph which shows that revenue expenditure has been, as a share of GDP as well as in terms of the growth rate, revenue expenditure has been reducing. Now, we can always argue whether this is a good thing or a bad thing because overall the size of the budget is contracting. Budget as a share of GDP, the total expenditure as a share of GDP is now only 14.2%. And within that, revenue expenditure, excluding interest payments, is just 7.5%. So there is a shrinkage there. But what is happening is that this time around, the government has reduced the expenditure on centrally sponsored schemes by 91,000 crore because the states are not able to spend. So the problem is not only of the central government. If the states are not able to spend, then they have to budget a lower amount for the centrally sponsored schemes for the next year.
Got
Pradhan Mantri Awas Yojana, Grameen, there you see that there is considerable underspending this year.
Yes.
Similarly, for other schemes also. And therefore, keeping that in mind for the next year, uh, some amount of rationalization has been done. Even on subsidies, there is a marginal cut. So there is some amount of expenditure rationalization that would help the government achieve its target. And maybe that they are not able to achieve the capex outlay also this time. Like last year, I mean, this year there is a underspending of 1 lakh crore. Maybe capex outlay, if they are not able to fix the implementation bottlenecks, maybe there is an underspending there also. And what they are budgeting is the non-tax revenue, which is the dividends from the RBI. They are again expecting a bumper dividend from the RBI at around 2.54 lakh crore, RBI as well as the state-run banks, which may or may not be true. How much RBI is able to give as dividends, that will depend on its income and its expenditure. Now,
Yeah.
its income may come down because globally interest rates are now coming down. So its investment in US T-bills will fetch it lower income this time around as compared to last year. So all these things have to be kept in mind. So in a nutshell, on the revenue side, there are some optimistic assumptions, but again, hopefully the government would be able to achieve its target by expenditure rationalization on both the revenue front as well as the
Uh,
maybe there could be some savings on the capex front as well.
So yeah, let's hope for the best that we achieve 4.4%. So overall, what I think that the budget is good. I mean, it has some growth prospects for a long term. So last question on the budget point. From your perspective, what are the three measures in the budget that were truly necessary and impactful? And on conversely, which three measures do you think will have a minimal impact or were unnecessary from your perspective?
So what was very good in the budget was that it has some vision for Viksit Bharat. So there is a lot of talk about skilling. Because if we look at last year's budget, there was talk about employment through internship schemes. But internship schemes and all will pick up only if there is emphasis on skilling. So this time the budget is talking about setting up centers of excellence, also centers of excellence for AI in education, because artificial intelligence is the most important thing shaping employment going forward. So there is emphasis on skilling, which is one good thing. The other important thing that the budget has done is that it is focusing more on reforms. It is focusing on deregulation. It has acknowledged that over regulation is something which is stifling growth, and therefore the economic survey also had a lot of emphasis that government should deregulate, digitize, decriminalize, and that spirit is followed in the budget as well, that there is a focus on bringing decriminalization. The Jan Vishwas bill, it will examine the various provisions where it can decriminalize, it will do. So all these things will help in easing the cost of doing business, reducing the cost of doing business. So those two are important things. Where it could have done better, I think it should perhaps focused more on health. Health did not find substantial emphasis in this year's budget, so that is something which is not that satisfactory. And the other thing is on tourism. Though there was talk about religious tourism, spiritual tourism, but it stopped short of having a concrete plan on how to boost tourism, because tourism is again something which has great employment potential. So those are the two things I would say that would have required more emphasis.
More emphasis. So, I mean, if I have to summarize, this budget is less about creating an employment. I mean, from one perspective, you can say, but it is more about boosting consumption. That I think that was the motive, but less on the employment part. So now,
I mean, employment and skilling, there was talk about, because if you look at the expenditure budget, they have allocated some amount for employment schemes and they have focused on skilling. So there is emphasis on that. But yes, the highlight that is
Highlight was
most
not bad.
important is to give a short-term boost, which was needed at this point in time. It
Definitely.
was needed that some amount of signal that the government is serious about boosting consumption, because after all 60% of our GDP is made up of consumption. We are not so much dependent on external factors. We will be insulated from external shocks if our domestic growth engines are firing well. So I think in that direction it's a useful budget.
So great on the budget side. Now I have one or two more question, which is not related to budget. At the recent conference, our former finance minister P. Chidambaram stated that even without the government intervention, India's GDP will grow approximately 4 to 5%, 4 to 5% growth rate. And I think, as you mentioned, that India in 60% of India's GDP is through consumption. So irrespective something is done or not, we will consume, and there will be a growth rate of probably 4 to 5%. But saying that without government intervention we'll achieve 4 to 5%, do you think it's a calculated estimate as per the economic fundamental, or it's just an oversimplified claim? It might be 2 3% without a government. So what do you think on this part?
So I think there are these economic players like consumers are there, small firms are there, MSMEs are there, producers are there. So some form of this economic transaction will take place and economic activity will go on. So long as economic activity goes on, some amount of GDP will be generated.
Yeah.
But the role of the government here, and it was very aptly captured in the last year's budget, last year's economic survey, that if the government is able to provide an enabling environment, it will give a boost to GDP. Like if there is enabling environment in the form of greater digitization, greater emphasis on the role of technology, greater emphasis on deregulation, decriminalization, and creating an enabling environment for small firms to also flourish. And because right now the regulations are such that it encourages firms to remain small. So they are not growing. So if something can be done so that firms do not face the fear that if they grow, then they will be under regulatory scrutiny. So all these things can be done and thought through by the government only. And what it can also do from the something can be done to boost manufacturing sector competitiveness, like slashing custom duties on imports, fixing the inverted duty structure. So, government policies do play a role in boosting growth. So, while I'm not sure about 4 to 5%, but yes, as you said, there would be some growth which will happen regardless of government intervention. But government intervention in the desired direction, in the form of focus on digitization, deregulation, decriminalization, and creating an enabling environment for private investors and foreign investors to flourish, that will be more sustainable. Because, as economic survey said, we cannot be okay with just 4 to 5% growth. We need an 8% growth uh, for a decade. And for that, we need to have an enabling environment, an enabling policy environment, a conducive environment, which can only be provided through reforms and through government's policies. So I think that will give a booster shot to growth.
Yeah, I mean, if you talk in terms of model, of course, we will have some intercept, irrespective, something will go in. But that beta component, the coefficient component,
Correct.
it helps government to, multiply on that side.
Absolutely.
Also, so one thing that, every year, every 2 3 years, we talk about, a different initiatives. For example, 2 3 years back, it was more getting into the manufacturing, you know, making the India more of the manufacturing, because we don't have service much, and we have a more of a consumption. And so the thing is that what is actually stopping India from doing all these things? Because for manufacturing we need skill, employment, education, health, and creating an employment. And one more important thing is that, like, for example, if we talk about startups, most of these startups that comes basically on the service based, because we try to get ideas from a different first world countries where services are the major part of their GDP. But why still there is a lack in the manufacturing sector? Because the way we have talked in last 2 3 years, manufacturing sector should grow. The grant was also mentioned, for the cheap manufacturing assembly, but why it is not growing? So where it is getting stopped? What's the obstacle that you think it's still keeping India to only grow by 6 7% instead of going towards a double digit? Because as we plan like 50 trillion economy by 2040, or if I'm not wrong.
Yeah.
So
We have to become, yeah, right. So
yeah,
Viksit Bharat
so
by 2047.
yes, and as Raghuram Rajan also mentioned, if we do a simple math, we need a double digit growth to go towards that level. So what do you think, like on a keeping everything aside, is stopping us from doing all these things?
Yeah, so there are various hindrances. One is from the manufacturing point of view, there are various taxes that need to be looked into. There's lots of studies that there are lots of taxes which are disproportionately falling on the producers leads to lowering of the manufacturing sector growth. The other is that we have this, production linked incentive schemes,
Yes.
PLI schemes,
Yeah.
which were designed to ensure improvement in the competitiveness of the manufacturing sector. But we have seen that it has worked well for only a few sectors and not for all. So there is a need to revisit the specifics of the PLI scheme, that why it has worked for some sectors but not for others. Do we need a PLI scheme as such? So the entire incentive structure that is provided to producers under the PLI scheme needs to be relooked. There is a need for a review of the PLI scheme altogether, that maybe it's important to add an element of employment generation, that the government will give some kind of incentives only if you do this much amount of employment generation. So for labor intensive sectors, if you are giving a PLI, it has to have some positive impact on employment generation. That is one. Also, it has to become more transparent as to how the government is, picking up companies to which it is giving incentives. So, in a nutshell, the entire PLI scheme needs a revamp. It needs a thorough review as to whether it is playing its role, it's yielding the desired results, or whether, without the PLI scheme, also the manufacturing sector would have posted the growth that it is posting right now. The
Irrespective.
other, right. So the other thing that manufacturing sector is, getting impacted is the China factor. Uh, on the one side, China has been dumping goods, cheap quality goods, because it is facing tariffs from US. So it's going to do that more in towards emerging markets, because itself it has reached a level of it's not
Self-consumption.
having. Yes, so and it is in the disinflation phase primarily. So it is dumping its goods in other countries, so which is harming the manufacturing sector. Uh, the other channel through which China is impacting us is because China is facing subdued growth, we are not able to export too much to China,
China.
because it's not that we are directly only exporting, we are exporting to China through a number of other countries as well. So China factor is very important. The other factor, as I said, is the entire tax structure needs to be reviewed. And thirdly, the PLI scheme also needs to be reviewed, that whether it's actually necessary, what kind of changes can be introduced so that it's actually having an impact on the manufacturing sector.
Got it. I mean, yeah, but there are other countries, those are also like doing, but Vietnam and all. But probably they're
Yes,
like towards developing countries. So even when you are very at the very lowest stage, even the small growth looks big. So probably we cannot compare India.
that also.
In fact,
And
yeah,
for each sector, we need to look idiosyncratically. Each sector is having its own problem, because, like textile sector, why Bangladesh and Vietnam are doing well, why we are not doing well, there are lots of factors. Because we are sending raw materials to Bangladesh, and they are using it to produce final goods, and then they are shipping to EU markets and US markets and so on. It's true that they are getting some concessions because they are developing countries, so they have market access which we don't have. But there is scope for improving our manufacturing sector competitiveness in textile. Whether we want to only focus on cotton clothes, or we want to focus on other kind of clothes which are in demand in other countries, we need to again, in textile there are a lot of small sector fragmented. Do we need to increase the size to reap the economies of scale and so on? So there's a lot of unorganized sectors as well. So all these things, for each sector, a comprehensive overview of the environment, of the policy environment, needs to be looked into, so that we can see it. And it's being done. It's not that it's not being done. We have tried to improve our export basket. We have tried to diversify our export basket. If you look at in the last 2 3 years, we have tapped into newer markets, for example, for leather goods and so on. And it's important that we continue that endeavor, so that we don't only depend on US and EU. We have other markets as well, which are more stable markets, and that will help us, improve our manufacturing sector competitiveness and the growth.
Okay. Yeah, I mean, let's hope for the best. And I think, like, yeah, as you mentioned, that that PLI skin needs some scrutiny and more kind of enhancement is required. More of like in the beginning, it was just started to probably make everyone aware that yeah, we want to become on manufacturing, and now probably it will take some time to get enhanced. Some changes are required. So thank you so much, ma'am, for joining my podcast. We had a great discussion and hope to see you again on some other topics.
Thank you for having me. Thank you.
Thank you. Thank you so much for listening my podcast. Please like, share, and subscribe. See you next time.